In this video, we're going to be going through the advanced topics of the income statement. So this is just a follow-up video to the basics of the income statement. And then we're going to have another video where we go through some extensive problems. It's going to have a separate video just because it's going to be so long. So first, we have something called unusual and infrequent gains and losses. We kind of have already looked at this a little bit on the first packet. I just want to go through a little bit of a more extensive look at this because it is something that, like, this extra information is stuff that we need to know for this class. So first, it's called the non-operating section from the first part of the packet. If you were to look at the first part of the packet, it's basically called the non-operating section. Okay, and so gains or losses considered unusual or frequent or both are reported in the non-operating section. Okay, and what does this mean? Well, unusual are events that are not related to the company's core operations and have a high degree of abnormality, and then infrequent meaning not likely to occur again in the foreseeable future. These are just kind of like more or less like the Financial Accounting Standard Board's definitions of these. Essentially, that's basically like kind of what they say unusual and infrequent is. Okay, you don't necessarily need to be able to determine if something is unusual or infrequent. You kind of just need to know like certain types of things, whether or not they would be operating or non-operating, just based off kind of like logically deducing, which as you sort of go through these problems, you'll be able to figure that out essentially. On the income statement, this section is called either other revenues and gains or other expenses and losses, right? So whenever we have these two subsections of the non-operating section, essentially, okay, as we kind of talked about in the first video, and then examples of unusual and infrequent gains and losses would be things like interest expense, interest revenue, gains or losses on the sales of an investment, losses on the write-down of an asset, or gains or losses related to a natural disaster such as earthquake, fire, or flood. Okay, so that's kind of what unusual or infrequent gains and losses basically are referring to. Okay. Next, we have our discontinued operation. A discontinued operation takes place when the following two conditions are met. And again, this is pretty much almost like exactly what the FASB says. I think it's almost just copied and pasted because, you know, this is just a definition. It's not super important that you know, like, memorize the definition. It's just good to be familiar with what it means. So basically it means that when the following two conditions are met, we have a discontinued operation. A company disposes of a component of its business. Now, a component comprises operations and cash flows that can be clearly distinguished operationally and for financial reporting purposes, okay? So we can distinguish the cash flows of this, you know, component. That's what a component is, you know, a piece of a business, basically. Okay. Second, this disposal represents a strategic shift in the company's business that has a major effect on the company's operations and financial results. Okay. So if these two conditions are met, we have a discontinued operation. Okay. Examples of a discontinued operation would be things like disposing of the division of a company, or a company decides to get rid of one of its major brands. Okay. So that's basically what a discontinued operation is, just a little bit more detail on it. We talked about in the first video in this packet, basically on the income statement, how it looks. And in the next video, we will have more detail about that as well in an actual problem. Okay. Then we have our non-controlling interest. Again, we don't need to know a ton about this. We just kind of need to understand a few things conceptually. Basically, it represents the amount of equity owned by non-controlling shareholders. So it's the people that own, so non-controlling shareholders are those that own less than 50% of the shares of stock. And on the income statement, income is divided between controlling and non-controlling shareholders. Okay, and this is something that generally you kind of need to know this conceptually. You don't need to like be able to do very much with it. You just kind of need to know, okay, this is what this is. It's not something that is covered very much in this class. It's covered more in classes that are in the graduate program for the Fisher School. Okay. And so as an example, again, you know, let's say we have this large parent company and they own 95% of a subsidiary. The 5% that is not owned by this parent company is considered to be non-controlling interest. It's the 5% not owned by the parent, and the 5%, and the parent must account for this, okay? And what we just said was that, you know, basically they divide net income between controlling and non-controlling. So in this case, 95% of the income would go to the controlling and 95% would go to non-controlling. Okay, so if you understand those concepts and the thing that was from the first video that went over, that's pretty much all you should need to know for that specific topic. It's not one that's, you know, basically extremely important for this class. Okay, it's more important in other classes, basically. EPS, earnings per share, it shows the company's net income per share of common stock outstanding. And EPS is calculated as follows. Again, it's net income minus preferred stock dividends divided by the weighted average common shares outstanding. This is a commonly used metric to evaluate a company's performance for the year. And then companies must disclose EPS on the face of the income statement, meaning that when you actually see the income statement, that on that income statement itself, we have to show the EPS on that statement. It can't be shown in the notes. Okay, that's basically what that means. And when we looked at the template, we saw that right below our net income, we had EPS. That's what it means on the face of the income statement. Right below EPS, we have it. Okay, sorry, right below net income, we have EPS. Okay, comprehensive income, and includes these extra items of income and expense that are not included in net income. The basic formula for comprehensive income is basically net income plus other comprehensive income equals comprehensive income. Okay. Now, our OCI, our other comprehensive income, includes certain items such as unrealized gains and losses on an available for sale security, amortization of a pension, prior service cost, or a foreign currency translation gain or losses. This is a pretty complex topic. Basically, what you need to know here is that, okay, you start off at net income. It's kind of complex, but if we break it down into separate pieces, it's not that bad. But basically, it's just our net income, right, which we can calculate. We know it's, we have quite a few things going into net income, but it's mostly revenue minus expense, right, along with a couple other things. And then we just add in our other comprehensive income items, which are things such as these right here that we just went over. And that gives us comprehensive income, okay? So there's two approaches to comprehensive income in terms of like preparing the statements. Okay, if we had to prepare a comprehensive income statement, we could do a one statement approach or a two statement approach. The one statement approach, it shows comprehensive income directly below net income on the same statement, and then it combines other comprehensive income and net income into one statement to arrive at comprehensive income. Okay, so basically we just have one statement with all net income and comprehensive income there, which we'll see in just a second what it looks like. Then we have the two statement approach, shows comprehensive income on its own statement and uses two separate statements, one to arrive at net income and then another to arrive at comprehensive income. So let's just look at basically what that would look like. Okay, so essentially here we have the two separate approaches to doing either a one statement approach or a two statement approach. Okay, so basically on the first one here, we have the single statement approach. So this one, the first one up here is basically the the one statement approach, I guess is what it's called. And you have all your items of sales revenue, cost of goods sold, everything like that. You arrive at net income, and then you literally just have a statement that says, okay, here's other comprehensive income. Let's list out these items of OCI, and then we have comprehensive income at the very bottom. This second one here is the two statement approach, where you have net income basically on the income statement. So this would just be shown on its own statement, the income statement. Okay, you just take this from the income statement and you start off at net income. You don't actually list out all these separate things above it. Okay, and then you just literally just say, okay, what are my items of comprehensive income, other comprehensive income, and then derive comprehensive income. Okay, so basically the difference is that, for the one statement approach, you have literally every single line item listed for your net income to actually derive the net income, versus the two statement approach has, you literally just go to your income statement and you pull your net income from there, and then you just list the other items. Okay, so that's basically the two statement approach versus the one statement approach. The two statement approach, you would have a separate income statement, and on top of this, versus the single statement approach at the top, you have every single item from the income statement listed to get to net income. Then you have all your other comprehensive items to get to comprehensive income. Okay, so that's basically what those look like. And that's the end of this video. We will have one more for basically going over some problems for this topic.